Welcome to the National Credit Awareness and Resolution Association podcast at NACARA.org, your source for navigating debt repayment challenges due to tough economic times. Today we'll explore how small business owners can more effectively use creditor tools, specifically the asset quality monitoring process. NACARA aims to bridge the gap between debtors and creditors as a paradigm shift allows debtors to propose their own repayment solutions. Let's get started. Let's talk about asset quality reporting, okay? First, we want to talk about the watch list designation and how they monitor loans that have a watch list designation. This is not an adverse credit risk rating or anything like that. It's just a designation that's given to loans with certain uncertainties, okay? A watch designated loan is still a pass loan. It's acceptable. Creditors who monitor credit risk by designating a watch use it as a monitoring or early warning system for loans that have temporary uncertainties. That's it. There are not yet potential weaknesses with the loan identified, just uncertainties to bring to management's attention. What sort of things will actually go into a watch list monitoring report? Well, I'll show you several. Number one, they'll talk about the borrower's exposure. They'll list each credit facility in the borrowing relationship. They'll describe the current uncertainties. Unlike a loan-rated special mention with potential weaknesses that may become well-defined weaknesses if not corrected, a watch list credit is where there is some kind of uncertainty that needs close attention. This may include things such as financial, operational, or managerial, ownership, industry, technology, labor, legal, environmental. Any of those areas could have some uncertainties in it, but those are going to be identified in such reports. Okay? The current trend. This will cite the trend of the uncertainty. Is it improving or deteriorating? Next, they'll discuss the resolution strategy, opinion as to the likely outcome on the uncertainty, and a summary of what it will take and how long to get there. So somebody will actually opine on how this uncertainty is going to end up. The report will also talk about accomplishments since the prior watch reporting period. Say it was a month earlier or a quarter earlier. What's happened since then? It'll document what has transpired since this prior watch reporting. It'll also identify triggers for watch list removal or a further downgrade. In other words, they're going to note the actual triggers that will either get this thing removed off the watch list or to downgrade it. So they'll have a resolution strategy, and the path will either be to remove it from the watch list or they'll talk about the prospect of potential downgrading. Either scenario will be broken down into smaller steps along with their estimated completion dates. So someone's going to think this right through, and they're going to put concrete steps that are going to be taken and the dates they expect things to be done by. Okay? That's all under watch list reporting, and you can see that in the transcript. You'll see how such a report might look. Now we're going to talk about the next level of asset quality monitoring for criticized loans. This is a bucket that also includes special mention rated loans, substandard, doubtful, or loss. So what about the loan monitoring for all of those? Okay, so loans that are classified as sub, doubtful, or loss, again, are called classified loans for regulatory reported purposes. Such loans are subjected to rigorous analysis and review by the primary relationship officer, the credit administrators, the special assets department, and even by senior management. So this is a comprehensive report. You can also see it on the transcript. The reporting is routinely reviewed by financial supervisors and regulators too. Such problem loans can have a great impact on the financial performance of the lender. So regular reporting will focus on the following items. Again, here's the things that are included in that, be it monthly or quarterly reporting for classified loans. Number one, borrower exposure. It'll include collateral protection, guarantor support, and it'll list and document each credit facility for each of these three areas respectively. Next, it'll also talk about the deposit relationship, financial reporting, and the loan covenants. It'll summarize that deposit relationship and the overall financial reporting requirements, as well as any other key financial performance covenants. And compliance, there too. Are they in compliance? And it'll note whether these covenants have been waived or forborne and show the reason as to why. That such asset quality monitoring for these classified loans will also talk about the repayment risks, the primary repayment source. It'll assess the risk of repayment for each individual criticized loan. It'll cite multiple reasons for there being increased credit risk. It develops, as applicable, the facts that support the repayment source, whether the cash flow, the net operating income, profitability, operating efficiency, leverage, liquidity, performance to plan, the pro forma outlook, management, competition, and other red flag warnings. It'll also discuss lender protection risks like the guarantors and any liens and collateral documentation. It serves as an additional secondary or tertiary source of repayment, these things are. Each is thoroughly analyzed and documented. Why? Because each of these sources of repayment could, in fact, should the primary source of repayment fail to pay, become the new primary source of repayment in the near term. The creditor will develop the facts that support the guarantor or sponsor strength, the mortgage or deed on commercial real estate collateral and its lien perfection, the UCC, Uniform Commercial Code, secured business assets, any commercial real estate risks, insurance, environmental risks, loan documentation issues, and even a character assessment. All these things will go into into the classified loan reporting. This short ad is sponsored by the Debt Crisis Problem Podcast. Attention listeners, please join us at tunabudget.com to tune into the Debt Crisis Problem Podcast, where in plain English we discuss the 20 risks that could soon fuel a serious economic downturn. We explore these critical risks and offer practical insights for navigating financial uncertainty. Join us for thought-provoking discussions that encourage transparency and awareness. Subscribe now to stay informed and be ready for whatever comes next. The next thing to include in a asset quality monitoring report for classified loans is the root cause analysis and the risk rating disposition, the accrual status, and upgrade and downgrade triggers. After the repayment risks and lender protection risks are adequately identified and documented, the root cause analysis will become clear, and the correct risk rating and accrual status can then be applied. Finally, the upgrade and downgrade triggers should fall automatically into place. The next thing for such monitoring will be the action plans, the actual steps to get to a pass rating or even to a zero balance. With input from the primary relationship officer, the credit administrators, or the Special Assets Department for the recommended action plan, a disposition will be made as to whether to keep or exit the current credit exposure. Measures may include, these are the options that the lenders are going to be looking at: a work out and retain or renew, to restructure the note like an A-B note split, a third-party refinance, collateral liquidation. Maybe they'll sell the note to another lender, or pursue litigation and a judgment or something else. The creditor will predetermine what it wants to do with your borrowing relationship as your credit risk profile changes. And they have documented rights to pursue the course they want, as well as the tools to do so. When creditors become overwhelmed, however, they will have to utilize more debtor-prepared repayment solutions. You have a strong voice all throughout this process. That's why it's important to understand the credit risk ratings and what that really means and how they're actually monitoring you and they're underwriting you, especially now that you can see this whole process and explain and understand what's happening. The action plans will identify the key steps necessary to return the credit back to a pass rating and the best estimated dates for completion, or similarly, to exit the entire relationship. Thank you for joining us. Today we covered the creditor tool asset quality monitoring, as debtors prepare to propose their own repayment solutions. But we want to hear from you. Share your own credit risk memo and debt repayment experiences, questions, and recommendations with us at NACARA.org. If you found today's episode helpful, please subscribe for notifications of future podcasts. Your feedback helps other small businesses stay in business as well. Until next time, step forward and take responsibility for your own debt repayment solutions. Thanks again.